Experienced investors frequently praise real estate as a wealth-building asset. However, getting your foot in the door can be challenging for new investors. Specifically, many real estate investment types require two things most novice investors lack: money and good credit. The good news is that you aren't ruled out of investing in real estate simply because you have bad credit. There are approximately 1 in 3 Americans who have poor credit, and if you are one of those people, don't worry, because you can improve your credit score and manage your finances in many ways. Hello and welcome back to the Finance Guardian channel. In this video, we'll talk about how to invest in real estate with no money or bad credit. Hit the subscribe button and the bell beside it and let's get started. Is it a good idea to invest in real estate if you have bad credit? When it comes to deciding whether or not to invest in real estate, your credit can certainly play a major role. The amount of down payment you can afford and your debt-to-income ratio or DTI can also significantly impact your loan options. Regardless of your creditworthiness, it is important to consider both the pros and cons of investing in real estate. Real estate can sometimes be marked as a passive income option, but maintaining a property and managing tenants can be demanding. And keep in mind that real estate isn't a guaranteed investment, as we've seen with prior real estate downturns. It may be possible to qualify for more favorable rates and terms if you improve your credit score and overall creditworthiness before taking out an additional loan. It will also make it easier for you to refinance or obtain additional loans if necessary. Buying an investment property with bad credit. You might have to turn to alternative loans or arrangements if your credit is so low that you can't qualify for a conventional mortgage. You could, number 1, ask about seller financing. Owner financing, also known as seller financing, is best used when a property is fully owned and paid off. This strategy could be a great option for sellers who don't need quick cash from the sale of their homes and whose cash flow isn't an issue. In terms of financing a deal, the seller acts as the bank. Essentially, you have a mortgage with the seller. These agreements allow you to make monthly payments until the property is paid off or the loan term is over. There can be a win-win situation for all parties involved in seller financing deals. Sellers dictate the terms. Many will not dig too deeply into your finances or credit score. At the same time, the seller is receiving a monthly income. For example, a retiree may be delighted with the idea of a set monthly payment. Similarly, a landlord might want to sell a property without completely exiting the market. Using seller financing in both of these situations could satisfy all parties while helping you build credit and capital along the way. Number 2, find an investment partner. Many people interested in investing in real estate would use their credit to fund deals as long as they didn't have to do the heavy lifting themselves. So why not partner up with someone like that? As a result, you'll be able to secure more funding for your deals. It's a win-win situation. Anyone could be your partner. It could be a friend, relative, colleague, neighbor, or a person you met at a local networking event. When searching for a partner, remember to seek someone with the skills and resources you lack and vice versa. If you lack the credit, you should partner with someone with excellent credit and can get the funding you need. And there could be something you possess that they don't. To achieve long-term financial success, consolidating debt and rebuilding your credit history may be a good idea. So what do you have to offer? This may be your time. Your deal-making skills are another resource. It is possible to work out a 50-50 partnership to share profits when the deal is closed. If you take this route, you must decide on a business structure and register your business. You can also seek legal advice from a business lawyer. As a result, if your partnership experiences problems down the line, your assets will be protected. Number 3, consider applying for a hard money loan. It may be possible for you to borrow money through a hard money loan instead of using a traditional mortgage lender. These loans are secured and their rates and terms are based on the property's investment potential rather than the borrower's creditworthiness. These loans usually have high interest rates and short payment terms, and they are best suited for investors planning to invest and flip a home instead of buying rental properties. Number 4, look into private money loan. The majority of hard money lenders are real estate professionals. On the other hand, private money lenders are simply individuals with money who want to invest. Private money lenders aren't usually investment professionals, so credit scores are unlikely to be requested. Nevertheless, private money lenders are likely someone you know well enough to lend you money. So you should only enter into such an arrangement if you're confident of repaying the investment. It's a good rule of thumb to refrain from borrowing money from people who can't afford to lose it. An attorney can also help you draft a loan agreement to review it. Number 5, take into account a government-backed loan. The credit and down payment requirements for government-backed mortgages, including FHA and VA loans, may be lower than those for conventional loans. Depending on your situation, you may be able to use the loan to purchase your primary residence. But if you purchase a multi-unit building, you can live in one unit and rent out the others. Multifamily FHA loans are available, as well as standard FHA and VA loans that can be used to purchase a 4-unit property. Other ways to invest in real estate with no money or bad credit. Consider alternative ways of making money from real estate instead of buying an investment property directly. A credit check is not always required for these options, and your credit score might not impact your choices or returns. Number 1. Invest in rate shares. Real estate investments trusts or REITs buy real estate and distribute rental profits to their investors. In the same way you buy stocks or mutual funds, you can buy shares in a REIT and receive dividends on a monthly, quarterly, or annual basis. As with stocks, the price per share is subject to change and could affect your overall returns. Number 2. House hacking. With no money or bad credit, house hacking is another option for investing in real estate. This practice involves earning income from a primary residence to outset its mortgage payment. Renting an extra bedroom, a studio, or an ADU housing is one way to do this. If you have no money and bad credit, you can buy a house and pay off its mortgage with the income you receive from house hacking. You may be able to live rent-free in certain cases. Investors can strategically invest in small multifamily properties that qualify for government-backed loans and live in one unit while renting the other. Number 3. Take advantage of crowdfunding real estate offers. A crowdfunding model is sometimes used to source real estate deals and to offer private real estate investments. You can review investments online and invest in individual buildings or funds. Nonetheless, some sites or investment opportunities are only available to accredited investors. The disadvantages of poor credit. Poor credit won't prevent you from getting a loan, but interest rates are higher than traditional bank loans. Depending on the lender, interest rates typically range from 10% to 15%. There are also points, which are a percentage of the loan that hard money borrowers must pay. The value of the points can range from 2% to 4% of the total loan amount. Therefore, you'll have to pay heftier fees for convenience. In some situations, it's okay given that the potential profit is high. Another issue is that they are unlikely to cover the property's full cost. The lenders typically lend 65% to 75% of the property's current value. Some lenders will lend money based on the property's value after it's been improved, also called the after repair value or ARV. As a result, you either fund the difference or find another funding source. How to improve your credit score. You can improve your credit while saving money for a down payment. If you plan to purchase an investment property, the process may take months or years depending on what's affecting your credit. But try to pay all your bills and loans on time. Reduce your credit card and personal loan balances. Check your credit reports for errors. Improve your credit score by adding positive payment information via apps and websites. Even though your credit may not be the most important factor in a decision, it may still have an impact on your options. For example, if you're considering hard money loans or investing with a partner, they may want to review your credit before making a decision. Even if you're able to close a deal today, improving your credit is a good idea for your financial future. And that's all the time we have for today's video, folks. We hope you enjoyed this video, and if you did, please hit the like button. And if you're new around here, subscribe to our channel to remain updated about all our future videos. We'll see you next time.